For decades, the US dollar has been the king of all currencies. It was the safe place to keep your money, the standard by which everything else was measured. If you lived in the United States, you probably never gave it a second thought. Why would you? Your salary, your savings, and your investments were all in dollars, and that felt secure. The entire world economy seemed to run on this single, powerful currency. This long period of stability created a sense of comfort, leading many to believe that the dollar's dominance was a permanent fact of life, as reliable as the rising sun. But times are changing. The ground beneath our feet is starting to shift. Quietly at first, and now more openly, people around the world are starting to question if the dollar is as safe as it once was. They see the US government printing more and more money, creating massive amounts of debt. They watch as international tensions rise, and they wonder if relying so heavily on one country's currency is a wise strategy. This isn't just a conversation for economists and big banks anymore. It's a real-world issue that affects your savings, your retirement, and your family's future financial security. This isn't about predicting a sudden collapse or causing panic. It's about being smart and proactive. When you see storm clouds gathering on the horizon, you don't wait for the rain to start pouring before you find an umbrella. Protecting your money from a falling dollar is like that. It's about recognizing a potential risk and taking simple, logical steps to ensure your wealth is safe, no matter what happens. Ignoring these signs is a gamble, and it's a gamble with the money you've worked hard to earn. Thinking globally is no longer a luxury for the ultra-rich. It's a necessity for anyone who wants to preserve their wealth. The core idea is simple. Don't keep all your eggs in one basket, especially if that basket is starting to look a little worn. If all your wealth is tied to the US dollar, your entire financial well-being rises and falls with its fate. By spreading your money across different currencies and different types of assets in various countries, you build a stronger, more resilient financial foundation. This essay will guide you through the practical steps you can take, from holding foreign currencies to owning international stocks and property, so you can go where you're treated best and protect what's yours. It's not just a feeling, the numbers are telling a story. In 2025, the US dollar experienced one of its sharpest declines in recent history, hitting a 3-year low. This isn't a minor dip, it's a significant trend that has caught the attention of serious investors worldwide. These are the people who manage billions of dollars, and their actions create waves across the global economy. When they start moving their money out of the dollar and into other currencies, it is a clear signal that they believe the dollar's status as the ultimate safe haven is weakening. They are voting with their wallets, and their verdict is that holding only dollars is becoming too risky. We are seeing a clear flight to currencies that are perceived as more stable or undervalued. For example, the Swiss franc, long known as a bastion of financial stability, has soared to a multi-year high against the dollar. Investors are willing to accept lower returns in Switzerland simply for the peace of mind that their capital is safe. Similarly, currencies like the euro, the British pound, and the Japanese yen are seeing renewed interest. These are not obscure currencies. They represent large, stable economies. The message from the market is unmistakable. Diversification is the new name of the game for capital preservation. This shift is also being driven by the actions of governments and central banks, not just private investors. According to a 2024 survey, a staggering 70% of the world's central banks indicated they plan to reduce their holdings of US dollars. These are the institutions that hold the world's official currency reserves, and for decades, they have been the biggest buyers of US debt. Their decision to slowly back away from the dollar is a monumental change. They are actively buying up other assets, particularly gold, to diversify their own reserves and reduce their dependence on American financial policy. When both the smartest private investors and the most powerful government financial institutions are doing the same thing, it's wise to pay attention. They see a future where the world is not dominated by a single currency, but is instead a multipolar system with several key players. They are not waiting for that future to arrive. They are preparing for it now. For the average person, this provides a clear roadmap. Following the smart money means looking beyond your home country's borders and exploring the opportunities and security that international diversification can offer. The era of blindly trusting the dollar is over. So why is this happening now? The weakening of the US dollar isn't caused by a single event, but rather a combination of powerful forces that have been building for years. A primary driver is US policy itself. The government has been running massive budget deficits, meaning it spends far more money than it collects in taxes. To cover this gap, it prints more dollars and issues more debt. A 2025 tax law, for instance, is projected to add another $3.4 trillion to the national debt. This constant creation of new money dilutes the value of every dollar already in existence, just like adding water to a soup makes it less flavorful. Furthermore, geopolitical events have accelerated a global movement known as de-dollarization. Countries are actively trying to become less dependent on the US dollar for trade and finance. A major catalyst for this was the use of financial sanctions, such as when the US and its allies froze around $300 billion of Russia's foreign reserves. This action sent a shockwave through the world. Other nations, including major powers like China and regional players like Iran, looked at this and realized their own dollar-denominated assets could be vulnerable. As a result, they are aggressively building alternative payment systems to bypass the dollar-centric SWIFT network. Central banks are also playing a crucial role in this changing landscape. They are the biggest money managers in the world, and their trust in the dollar is visibly eroding. Many have significantly increased their purchases of gold, an asset that cannot be devalued by a government's printing press. Gold holdings in official reserves have more than doubled since 2015, now accounting for over 23% of the total. This is a deliberate strategy to hedge against the risks of a dollar-centric system. They are not just talking about diversification, they are actively rebalancing their portfolios away from US debt and into tangible sovereign assets. While a complete and sudden collapse of the dollar is unlikely, the trend is clear. The world is moving toward a multipolar currency system. Experts at institutions like the Atlantic Council project that the dollar's share of global reserves could fall below 52% by 2035. The Federal Reserve itself acknowledges these trends, even while stating the dollar remains dominant for now due to the lack of a single viable alternative. But the writing is on the wall. The dollar's crown is slipping, and waiting for a perfect replacement to emerge before you act is a strategy fraught with risk. The smart move is to prepare for a world with multiple strong currencies. The simplest and most direct way to protect yourself from a falling dollar is to hold some of your cash in other currencies. This doesn't have to be complicated. It's about spreading your liquid savings across several strong, stable currencies so that a decline in one doesn't wipe you out. Think of it like having a portfolio of cash. One of the most accessible options is the euro. It is the currency of a massive economic bloc, and with analysts forecasting it could strengthen significantly against the dollar. It's a popular choice. Opening a bank account that holds euros is easier than you might think, with jurisdictions like Georgia or Singapore offering straightforward options for non-residents. Another strong contender is the British pound. While it has faced its own challenges, many analysts believe it is undervalued and poised for a rebound. Holding pounds gives you exposure to the UK economy and its world-class financial center in London. Similar to the euro, you can open pound-denominated accounts in international banking hubs like Singapore or Hong Kong, or through specialized offshore banks. By placing some of your savings in pounds, you are making a bet that the UK's economic fortunes will improve relative to the United States, providing you with a hedge against dollar weakness. For those seeking maximum safety, the Swiss franc has long been the gold standard of currencies. Switzerland's history of neutrality, political stability, and fiscal discipline has made its currency a go-to safe haven during times of global uncertainty. While opening a basic Swiss bank account can be difficult for non-residents, it's possible to gain exposure through private banks in Switzerland itself or in other wealth management centers like the Bahamas. The franc often strengthens when fear is high, making it an excellent insurance policy for your portfolio against global turmoil and a declining dollar. Finally, don't overlook currencies from stable emerging markets. A good example is the Malaysian ringgit. While it may seem like a more exotic choice, some analysts predict a significant strengthening of the ringgit against the dollar as Malaysia's economy grows. The benefit here is the potential for higher returns compared to the more established currencies. Opening a bank account directly in Malaysia is a viable option for those willing to do a bit of paperwork. Diversifying into a mix of established currencies like the euro and pound, a safe haven like the franc, and a growth-oriented currency like the ringgit can create a robust and well-balanced cash position. Holding foreign cash is a great defensive move, but to really grow your wealth, you need to invest. Buying stocks in companies outside the United States is a powerful way to diversify away from the dollar, while also capturing growth potential from other parts of the world. When you buy shares in a European company, for example, your investment is denominated in euros. If the euro strengthens against the dollar, the value of your shares increases in dollar terms, even if the stock price itself doesn't change. This basically gives you two ways to win, from the company's performance and from the currency's appreciation. Europe in particular offers many attractive investment opportunities. You might notice that European companies often offer higher dividend yields than their American counterparts. For example, a major European bank like BNP Paribas might pay a more generous dividend than a US bank like JP Morgan Chase. This means you get paid more just for holding the stock. Accessing these markets is no longer difficult either. Brokerages like Interactive Brokers offer global trading platforms that allow you to buy stocks on exchanges in Frankfurt, Paris, or Milan with ease. Alternatively, you can open an account with an offshore brokerage in a location like Switzerland for added asset protection. The United Kingdom is another market definitely worth exploring. The London Stock Exchange is home to many global giants in industries like finance, consumer goods, and resources. You could invest in a stable, dividend-paying tobacco company, or a high-growth bank focused on emerging markets like Bank of Georgia, which is conveniently listed in London. These investments give you direct exposure to the British pound and the UK economy. By owning a piece of these businesses, you are not just hoping for the pound to rise. You are investing in the underlying value and cash flow of successful international enterprises. The key takeaway here is that you are not just buying a stock. You are buying a business that operates in a different economic environment and earns revenue in a different currency. This is a fundamental layer of diversification that goes beyond simply holding foreign cash. It aligns your wealth with the productive capacity of other strong economies. Whether it's a German car manufacturer, a French luxury brand, or a British bank, owning international equities ensures that your financial success is not solely dependent on the economic health and currency stability of the United States. It's a strategic move to build a truly global investment portfolio. For those looking for a tangible asset that you can see and touch, investing in real estate outside the United States is, honestly, an excellent diversification strategy. Owning property in another country provides a powerful hedge against a falling dollar, because its value is inherently tied to the local currency and economy. If you buy an apartment in Lisbon, its value is in euros. As the euro strengthens against the dollar, the value of your property, when measured in dollars, automatically increases. This provides a stable, long-term store of value that is less volatile than the stock market and is physically removed from your home country. Many countries in Europe offer attractive real estate investment opportunities, some of which come with incredible added benefits. Nations like Portugal and Greece have golden visa programs where a qualifying real estate investment can put you on a path to residency and even citizenship. This means your investment not only protects your wealth but also gives you a second passport, the ultimate insurance policy. Imagine owning a beautiful villa on the Mediterranean coast that also grants you the freedom to live, work, and travel throughout the European Union. It's a strategy that combines asset protection with lifestyle and mobility benefits. Even in countries without golden visa programs, the benefits are substantial. Consider Serbia, a growing economy in the heart of the Balkans. While not in the EU, its property market is often priced in euros, making it a straightforward way to get euro-denominated exposure. Buying an apartment in a city like Belgrade can provide strong rental yields and the potential for significant capital appreciation as the country continues to develop. This type of investment anchors a portion of your wealth in a physical asset, located in a different political and economic jurisdiction, adding a robust layer of protection. Owning foreign property is more than just a financial calculation. It gives you a real foothold in another part of the world. It can be a vacation home for your family, a rental property generating income in a foreign currency, or simply a safe place to park your capital. The process involves working with local lawyers and real estate agents, but it's a well-trodden path for many international investors. By converting some of your dollars into bricks and mortar abroad, you are building a fortress for your wealth that is resilient to the currency fluctuations and political uncertainties of any single nation. For thousands of years, through the rise and fall of countless empires and their currencies, gold has remained the ultimate store of value. It is the original real money, an asset that exists outside of any government's control. Unlike dollars, euros, or yen, a central bank cannot print more gold. Its supply is finite and difficult to increase. This is why, during times of economic uncertainty and currency devaluation, investors and central banks alike flock to the safety of gold. It acts as a reliable insurance policy against inflation and the erosion of purchasing power that comes with excessive money printing. When you see central banks around the world increasing their gold reserves, as they are doing now, it's a powerful signal. They are hedging their own bets against the very fiat currencies they issue. They understand that in a crisis of confidence, gold is the one asset that is universally trusted. For an individual investor, owning physical gold serves the same purpose. It provides a solid foundation for your portfolio that is not correlated with stocks or bonds. When financial markets are in turmoil and currencies are falling, gold often shines brightest, preserving your wealth when you need it most. Owning physical gold is the recommended approach rather than paper gold like ETFs. Having the actual metal in your possession, or stored securely under your name, removes counterparty risk. The question then becomes where to store it. While keeping some at home is an option, for true asset protection and peace of mind, storing your gold offshore in a secure private vault is the superior strategy. Countries like Switzerland, Singapore, and Austria have long traditions of secure private storage, offering non-bank vaults that are completely separate from the financial system. This ensures your assets are safe from potential government seizure or banking crises in your home country. Integrating gold into your diversification plan is a timeless strategy for wealth preservation. It should not be seen as a speculative investment to get rich quick, but rather as a defensive anchor for your portfolio. A common allocation is between 5 and 15% of your net worth, depending on your risk tolerance. By converting some of your depreciating dollars into the enduring value of physical gold and storing it safely abroad, you are taking a page from the playbook of the world's most sophisticated investors and central banks. You are building a financial fortress with a foundation of the oldest and most trusted money in human history. In the modern search for alternatives to the traditional financial system, a new contender has emerged: Bitcoin. Often called digital gold, Bitcoin shares some important characteristics with its physical counterpart. It has a strictly limited supply. There will only ever be 21 million Bitcoin created, a rule enforced by its underlying code. No government or central bank can print more of it, making it inherently resistant to the kind of inflation that plagues fiat currencies like the US dollar. This scarcity is what gives it the potential to act as a long-term store of value in a world of endless money printing. Bitcoin operates on a decentralized network, meaning it is not controlled by any single entity, bank, or government. This makes it a truly sovereign asset. When you hold your own Bitcoin, you have complete control over it. It cannot be frozen or seized in the same way money in a bank account can be, as long as you protect your private keys. For individuals concerned about capital controls or the increasing power of governments over the financial system, Bitcoin offers a powerful escape hatch. It represents a parallel financial system that is global, permissionless, and censorship-resistant. However, it is crucial to understand that Bitcoin is also a much newer and more volatile asset than gold. Its price can experience wild swings, making it unsuitable for money you might need in the short term. For this reason, it should be viewed as a speculative component of a diversified portfolio, a high-risk, high-reward bet on the future of money. A small allocation, perhaps 1 to 5% of your portfolio, can provide significant upside potential without exposing you to catastrophic losses if the price falls. It is an asymmetric bet. The potential gains could far outweigh the initial investment. Just like with gold, how you hold your Bitcoin matters immensely. Leaving it on a crypto exchange is like leaving your gold in someone else's vault without your name on it. You're exposed to the risk of the exchange being hacked or going bankrupt. The best practice is to take self-custody of your Bitcoin using a hardware wallet. This small, secure device stores your private keys offline, giving you full and exclusive control over your digital assets. For added protection, you can even store this hardware wallet in the same offshore private vault where you keep your gold, creating a multi-asset bastion of personal sovereignty. The era of assuming the US dollar is the only safe place for your money is drawing to a close. The evidence is all around us, from the actions of global investors and central banks to the clear policies of the US government itself. Sticking your head in the sand and hoping for the best is not a strategy. It's a gamble you can't afford to lose. The good news is that you don't have to be a passive victim of currency devaluation. By taking proactive steps today, you can protect the wealth you've worked so hard to build and even position yourself for growth in the years to come. The core principle is diversification, but not just the kind your local financial advisor talks about. True diversification means spreading your wealth across different countries, different currencies, and different asset classes. It means moving beyond a portfolio that is 100% exposed to the US dollar and the American economy. Start by holding some of your cash in stable foreign currencies like the euro, Swiss franc, or British pound. Open an international bank account. This simple first step immediately reduces your risk and gives you more options. Then, build on that foundation. Invest in high-quality international companies to capture growth and dividend income in other currencies. Buy a piece of real estate in a country you enjoy, creating a tangible euro-denominated asset that can also provide lifestyle benefits and a second residency. Anchor your portfolio with the timeless security of physical gold, stored safely outside your home country's political reach. And for those with a higher appetite for risk, consider a small allocation to Bitcoin as a bet on the future of decentralized finance. This isn't about being pessimistic, it's about being realistic and prepared. You are building a robust, resilient financial life that can withstand storms from any direction. By spreading your bets, you ensure that a crisis in one country or a decline in one currency doesn't devastate your entire net worth. You are taking control of your own financial destiny and embracing a world of global opportunities. The future may be uncertain, but your approach to protecting your wealth doesn't have to be. Go where you're treated best, and build a portfolio as global as your ambitions.